So, Dom Chu, we talked about it earlier, uncertainty, volatility, those do appear to be the watchwords. But for now, the other watchword is Navigator.
It is. We're going to navigate through the worst performing sector in the entire S&P 500. That's the consumer discretionary side of things. So far this year, it's been terrible. And at first glance, you might think it has most to be concerned about when it comes to things like tariffs, especially for some of those car companies and other consumer-focused names. But our next guest says once we get some more clarity on President Trump's tariff policies, if the tariffs end up being less bite than expected, that sector could actually overcome what he calls the tariff tantrum that's happening right now and make a decent comeback. So we're going to turn back now to Jeff Kilberg, the founder and CEO over at KKM Financial. And Jeff, I know that this consumer discretionary trade is one that is overwhelmingly tilted from a mathematical standpoint towards Amazon and Tesla. But it's not just about that particular set of names. It is also about the move in consumer discretionary overall. Why do you think it bounces?
Well, I believe, Dom, that we are going to have better than expected, or I should say, I think more fear has been priced in the overall marketplace. And if you look at from a sector dispersion perspective, once again in 2025, we've seen great sector dispersion. And we're seeing technology down a lot, but it's a close second to consumer discretionary. And to your point, XLY is heavily weighted in Amazon and Tesla, but it also has McDonald's and their Home Depot and Booking. So those top 5 names, which represent more than 50% of the portfolio, have the ability to really snap back. Think about a rubber band in Tesla or even Amazon, which is down. All of those top 5 holdings, actually, except for McDonald's, are down year to date. So I am in the camp that President Trump is using this as a negotiating tactic. He may even throw a caveat on tomorrow saying that they have X amount of time for these tariffs. So there's going to be a couple curveballs tomorrow. I know we're seeing the market oscillate right here around 5,600 in the S&P 500, but XLY has the ability to snap back if I'm right.
All right, so if you are right, hypothetically, how exactly do you express that view, Jeff? Do you use it with the options market? Do you kind of play the individual names? And what exactly is the trade setup for you?
Well, that's the beauty of options, Dom, and that's where I want to be a call buyer. I want to define my risk because if I'm wrong on the tariffs, we're going to see the market move lower and XLY will continue its descent. But I want to be a buyer, and I bought on the open this morning. I know we're a couple dollars higher in XLY. XLY was actually up at 201 just about an hour ago, but I bought the 200 calls expiring at the end of April, April 25th. I paid about $4.50 for those calls. They're trading about $5.30 right now, but it gives me the opportunity to break even if XLY goes above 204.50. If it reclaims that moving average and goes up and tests the moving average of the 50-day in XLY 215, that's where there's unlimited upside. But in options, you have the ability to define your risk. So by defining what I'm paying for these calls, if we do see XLY go down, I'm not going to lose money like I would if I actually owned XLY in an underlying ETF.
All right, one contract worth 100 shares, so $4.50 turns to $4.50 for possibly unlimited if it goes above 204.50. Jeff Kilberg, thank you very much for the trade on consumer discretionary. We'll see you again soon, sir.